Let's go through a real income statement. I want to point out some of the important aspects. To start, the name. The consolidated is meaning that this statement is the activity of American Eagle, the parent, as well as all subsidiaries that American Eagle has control over. The name statement of operations, that can vary. It can say statement of income, it might say statement of earnings. There's a variety. Hopefully you'll be able to identify the statement because knowing the 4 different statements, it hopefully will be pretty self-evident that you're looking at the income statement. And if you can't tell from the title, I would hope you would be able to tell by the information that's in here, given what you've learned to date. Let's go through and notice the year end. It's not a calendar year end, it's what they call a fiscal year end, and it's ending, and it's probably the last Friday or the last business day of January. So you can see here that it's for the fiscal year 2011. One of the months actually is in 2012. Let's go note here that this is in thousands. You have to be really careful about that when answering questions and assessments. If I ask you what's net sales, your answer should not be $3,159,818. It should be $3,159,818,000, adding 3 zeros to your number. Sometimes they're in millions. It depends on how the company wants to round their numbers or their amounts. As you know, net sales represents the price they've charged their customers for goods they delivered. And as you know, this will not equal the cash collected, because you'll see on the balance sheet that there's probably accounts receivable or maybe unearned revenue. Cost of sales, that's the cost of these goods that they sold, and cost of sales, another name you'll more commonly see, is cost of goods sold. Gross profit. Now this is a multi-stepped income statement. This is a subtotal. It's just telling you how much they marked up their inventory or the goods that they sold. That's quite the markup. We'll talk about the gross profit margin now. If you look down below here, it's one of the ratios you'll need to calculate. The gross profit margin in this example, it measures the markup. You take the gross profit, and then you divide it by the sales. Now you could lop off the 3 zeros if you do it consistently for the numerator and the denominator. Anyways, this comes out to be 36% rounded. So basically for every dollar of sales, they're marking up their goods by 36 cents. So the average cost of their inventory is 64 cents for every dollar. Okay, now below gross profit, these are what they call operating expenses. They lump or consolidate a lot of these together. In selling general and administrative expenses, you'll have all kinds of things like wages and salaries, and you have rent, insurance, advertising, and the list goes on. So here is the amount consumed during the period. Again, it doesn't mean they've paid that. We'll probably have payables or prepaids as well. Loss on impairment of assets is beyond the scope of this class, or at least at this stage, and that just represents that some of their assets have lost value, and it would not be conservative to leave the assets at their cost. We know what depreciation is. This represents the amount of usefulness used of American Eagle's long-term assets, and realize this is an estimate. Operating income, a very important subtotal. I like using that in terms of, I know this has better predictability than net income. The reason is between operating income and net income are items that don't relate to your operations, and they'll often vary. Like you can have gains and losses from things that you don't normally sell, and so you might have more fluctuation in net income. And you have to recall that when you're looking at, say, purchasing stock, past performance is no guarantee of the future. So you have to basically take what you think is going to be a better number in terms of predicting what's going to happen in the future. Now, as far as, let's jump down to net income. An important measure is your net profit margin. What companies or analysts will want to do is take net income and then divide it by your sales. And the end result is it measures the amount you earned on each dollar of sale. So American Eagle, when you take those amounts, they earn 5%. So it's translated into saying that for every dollar of sales, American Eagle cleared 5 cents, which may not seem like a lot, but actually it's not a bad return, especially given the economic downturn that's been experienced. Now, I want to point out earnings per share, and what this number basically is you're taking your net income divided by the shares that get to share in your net income. Well, it's a little more complicated, but just in general, you take your common shares and divide it into the amount of net income. What the earnings per share will though be is you'll use the shares that are outstanding, meaning any shares that American Eagle has bought back and holds in its treasury won't get to share in the net income. You see here we have diluted earnings per share. It's beyond the scope of this class, but the idea is that if they were to reissue, say, their treasury stock, or if they had any other types of stock that could be given or sold to the general public, that it would dilute their earnings. You can see here it would be a penny less if all those shares that American Eagle held were to be introduced into the stock market again. In general, on both these ratios, the higher the better.